Hey, thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel. A lot going on in the news this week here. We're going to piggyback off of what took place over the weekend. A lot of people are starting to sound their small alarm bells to say 2024 might not be so exciting. Positively exciting. Let's take a look and see what some other smarter people have to say about it. Let's start off today with a little bit of crypto update. Bitcoin is at 42,000 and change. It's up 2.5% for the day. Ethereum crossed the 2,200 here recently. XRP holders were at 61 cents. Solana is up to $60 so far. Cardano at 40. Charles Hoskinson said something the other day, which I thought was super funny. He said he used to tell people that he printed money for a living. Probably not such a good idea to say that, but the best part was the reaction of the Bitcoin guy afterward. He was like, what? Anyway, gold is popping off here. We got 10% so far for the year. For gold, where a lot of folks are saying gold is a dead instrument to place your money in, crossing the 2,000 limit for the year. Over here at X, formerly known as Twitter, Zero Hedge says a Goldman Sachs Uber bull is now turning bearish. He says the rally has absolutely run out of gas. That does not sound like a positive spin on where the market is today. Recently, the Federal Reserve came out with their beige book talking about some commentary for the current economic conditions. It's 32 pages. You can find it online. They break down some of the divisions, or districts, I should say, in the U.S. into 12 different districts. And what do they have to say? They said economic activity is slowing since the last report a month ago. 4 districts have modest growth. 2 of them are slightly down, and 6 are slightly down in activity as well. Retail sales, autos, discretionary, durable is all declined. Demand for transportation is down. Demand for business loans are down. Agricultural conditions are steady, slightly up. Commercial real estate activity is slowing down. Things are starting to slow down, it looks like. Recently, Mara Pandit, JP Morgan asset manager for global market strategists, says 2024 outlook for the stock market may only be 5%. Their response in this interview was, if you're only going to get 5% in the market, why not just grab a treasury bill at 5%, or a CD, or some other sort of bond that would get you 5% as well? Reaction was, yeah, you're kind of right, but we don't want to miss the upside potential. I don't know. I think, as you can see in the 80s, kind of a slowdown. If you can get a 12% CD, why would you take the risk in the market? I think it's interesting.
And just to support those revenues, I'm not sure that double digits is realistic. Even on
how
the
much
fixed income
stock
side.
then? What would you do? What would your equity allocation be for the next year?
I think we don't want to stray too far from strategic here. Still having that 60% roughly equities, 40% bonds.
You just said 5% if you're lucky, and maybe down 10. Why not get 5% in a 2-year?
Well, I think that's the balance within portfolios. We don't want to give up the upside within the equities. We know that there's potential.
Also, Mohammed El Arian is the president of Queen's College in Cambridge and also chief economic advisor at Allianz, is saying that hopefully the Fed should start to target a 3% inflation instead of 2%. This guy is way smarter than I am. However, my 2 cents, if the Fed starts to target a higher inflation rate of 3%, that allows a little bit of a cushion to be close to 3, kind of 3-ish, 3.5, 4, 4.5. I've got a strong feeling that inflation is going to be much more consistent, and it's going to be much more a part of our everyday lives here going forward. Yeah, I'm not too excited about it. And lastly, JP Morgan's Jason Hunter, one of the top chartists, says...
What I couldn't understand is you do think maybe we'll orchestrate a soft landing, but in doing so, we'll start perceiving the recession risk as much higher than we do right now, and that will hurt stock prices?
Yeah, that's correct. Yes. Yeah, because when you look at the timing since curve inversion, and go back into the 1960s and take yield curves that go back that far, as we move into next year, as that window continues to progress, you tend to find your way into a bear market that's eventually associated with a recession way more often than not. The odds are stacked in favor of a hard landing, actually. Our house view is that we actually land in soft landing. But when you look at how markets are priced right now, they're very much priced for a soft landing. Between here and there, we have the unfortunate experience that we're going to have to go to stall speed. That's what enables the Fed to start easing in the second half of the year. And just that trajectory, the market's going to have a significant gut check of whether that inertia is going to carry to a...
I don't know. A lot of people are starting to come out here. It doesn't have the best expectations for next year, but you tell me your 2 cents on where you think the market's going to go. We're focusing a bit on the TradFi here today. Thank you so much, as always, for chiming in and commenting below. Make sure to hit the bell button for any bell notifications that you want to see coming forward. Hit the like button as well and subscribe if you want to see more. Thank you so much for listening to the end. As always, stay inquisitive, stay informed, and stay subscribed for more. We will see you tomorrow.